Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, hello and welcome to Pilot Money Guys, Flight 124. I have a special guest today, Nolan Clark, CFP. Nolan, welcome. Glad you're on the show with us.
Thanks, Charlie. Yeah, great to be back.
Awesome, man. We'll appreciate you taking the time today. And we've got a lot of fun things to talk about today. We're going to do, this is kind of our Roth, how to get more Roth part 2. We actually have an official name on the part 1, but I forgot what it was for part, it's already posted. I think it came out today. But anyway, this is part 2. We're still going to continue on this path of, the new changes, the IRS rules that change for Roth catch-up 401k, Roth NEC. You're going to cover today a couple things like mega backdoor Roth. And all these implications, who should be thinking about Roth? It's really important. We talk about it a lot with our clients. So we're going to continue down that path and provide some actionable ideas. In fact, Nolan, you weren't here last week, but we have a new mission for Pilot Money Guys. And it goes like this. The mission of Pilot Money Guys is to deliver actionable ideas, simplify the complex, and cut through financial noise, all to help you build a mindset for financial and life success.
I love it. I saw that on the show notes and I was like, that's new. I like it.
It's awesome, man. I kind of made it up on the fly last week because it's what we do, is what we love to do, and try to help our pilot audience as much as we can. But then, Nolan, you put something that's a little bit rough into AI. It's pretty amazing, actually. So that helps quite a bit.
That's right. I love the simplify the complex because you mentioned this Roth stuff. I mean, man, you got the backdoor Roth, you got mega Roth, all these titles. So I think that's part of the mission today, is to simplify that.
Absolutely. And we've my buddy Brian, Southwest guy Brian, told me, I listened to your podcast. You guys confused the hell out of me. And what do I do? So feel free to shoot an email our way, Nolan at leadingedgeplanning.com, Charlie at leadingedgeplanning.com, and we will answer if we do confuse, because sometimes it's not simple. But we were going to try to continue down the path today to add some actionable ideas, like I said. And Nolan, what part of that mission that I love is to cut through the financial noise as well, because there's a lot of it out there. If you are watching YouTube videos, reading blogs, man, there is a lot of information. In fact, one of our clients forwarded me a video and said, hey, this guy says that you should not do Roth conversions all the time. And I said, yeah, that's right. You should not do Roth conversions all the time. So it's a little bit of a clickbait title, but the point of the video was correct in that these Roth conversions or backdoor Roths or mega backdoor Roths, it's very nuanced for your situation. And still there's a lot of unknowns, Nolan. So it's not easy.
That's so true. I think the main thing is just that all of these decisions are so unique and personalized. You really do have to consider your own personal situation. That's why sometimes these videos may seem confusing, but then when we can tailor it to your financial situation, it does become a little clearer, because there's not a cut and dry solution for.
And everybody has different preferences. We tell the same information to a couple different people, and they may take different steps because they just have different preferences, and that's normal. But first, Nolan, questions from the flight deck. Okay, I'm going to give you a quiz. Since November 1st, 2025 until today, how much is Southwest stock up?
77%. And I'm cheating because we looked at it before. But if you would have asked me, I think yesterday you mentioned that, I would not have guessed that. And I think you'll get into maybe why we wouldn't have guessed that. But
yeah, I wish I knew why exactly.
Yeah, that's right.
But anyway, I wish I knew it was going to happen. But it's fascinating that it's January 28th, it was up like 38%. And I think it was maybe the quarterly profit calls. I think it's Bob Jordan, CEO, and they do a CEO at every publicly held company has to do these quarterly calls, and they get grilled by the investors and all that. But obviously, it's some pretty good news. Stock went up. Now, the interesting thing, Nolan, is I talked to somebody the other day, and they said, I always sold my Southwest stock right before the quarterly call because it always went down, regardless of the good news. Well, this time it didn't. It went straight up.
Yeah, but they're shaking their fist right now, right?
You never know, man. Single stock investing has a way of making us feel stupid all the time. But what does it mean for people? And we've got people that were itching to sell, and we're going to talk about other airline stock here in just a minute, but this is just a fascinating observation. There's really no, this is you and me bloviating a little bit, Nolan. So that's
Right.
the word I'll use here. But there's really no real lesson learned, except it's just fascinating. Single stock is just totally unpredictable because Southwest stock had been really bad for the last 5 years. And it's still, the last 5-year annualized rate of return is 2%, 2.43%, including the 70% rocket ship we just had. So it's still not wonderful. Can you time these things? What do you do? We've had people that are itching to sell them before, and I would say we're not giving recommendations, but if you desired to sell it before when it was bad, well, now's your chance. But the tough part, Nolan, behaviorally speaking, is, well, what if it goes up more and then I'll miss out?
Yes, exactly. Yeah.
Yeah. It's interesting. It's that we have that recency bias, and oftentimes we only buy stocks or silver or gold or Bitcoin because it went up. Right, Nolan?
Yep. And that's not the time to buy, is it?
Exactly. It's there's a couple of things we always say. It's like you cannot buy yesterday's returns, and you cannot invest in the rearview mirror. So if you didn't buy silver already, it's over. It's too late. Just my opinion anyway.
And I think the market, in a bigger lens, it's a information processing machine, right? By the time that we hear the news that we think a stock is going to do something, it's already been baked in, right? And so it's so hard to predict these things. And I think, like you said, we really don't have aside from that much a learning lesson, but it's interesting. It really is.
And it's I'm always fascinated in the behavioral science of it all, because when sometimes we see that rocket ship of returns, we want to be on that ride, and it's oftentimes too late. But still, we have what's called the recency bias. I don't want to turn this podcast into a behavioral science thing, but we all suffer from the recency bias. Nolan, it prevents us from getting run over at the stop sign in the four-way intersection because we react quickly and we take that recent information, and it saves our lives. But in the world of stock market, stock investing, it can hurt us because we look at the last month or two and we go, wow, that's incredible. Let's open that lens or widen that lens a little bit. And still, Southwest stock for the last 5 years is still annualized 2.5%, 2.4%. Delta is annualized 11.75% the last 5 years. United is down currently year to date 5%. So it's the dog right now, right? But it's annualized 20% in the last 5 years. So if you kind of said, I wish I would have bought something, it's probably United that you may feel that way about. Yeah. I cannot leave American Airlines out because we have a lot of American Airlines friends and pilots, and their 5-year look back is minus 3.8. And so they've had a rough go of it. That stock has been down for a long time. So maybe we'll root for American to have that 70% rocket ship right here soon, right?
That's right.
I think for me, Nolan, I just single stocks, especially your employer's single stock, is just too emotional. You know what I mean? Too emotional and impossible to time.
And Charlie, maybe last thing on this, it kind of reminds me of a question we get of, employer stock purchase plans.
Yeah.
I think that could kind of go along with this. Like maybe we get questions of, should I save in my employer stock purchase plan?
Yeah.
And so I think not a cut and dry yes or no, I would say, but maybe there's some savings priorities going on there. But what do you usually tell our pilots about that?
I think you nailed it, Nolan. Like, it's a savings priority to me. I'm going to think about, my 401k. I'm going to think about, of course, emergency savings, debt, all that kind of stuff we understand. But an employee stock purchase plan has a discount. And so that's kind of nice. And so, but it's still going to be 3 or 4 or 5 down the list for me, because I'm going to try to get the Roth like we're going to talk about today. And if I still have money, left over, which is very unlikely for me, then I might consider it. But nonetheless, it's not something that it usually makes my priority list, although it's not a bad thing. You get a discount. So
absolutely.
It's about 2 cents anyway, Nolan, for whatever that's worth. But hey, let's jump into the meat of the mission. But we're going to remind everybody a couple things real quick. One of them you can talk to us about is the NEC Roth option. Yeah. The other is the requirement for most of our airline pilots. If you made more than 150 last year, your 401k catch-up must be Roth.
Mhm.
The big deal there, Nolan, is we're trying to get out as a public service message is
Right.
that some of our pilots that, and this is at every airline, Nolan, United, American, Delta, Southwest, you've got to go in your 401k and you have to adjust the setting. It's not a status quo thing. It's not a default. You've got to go in there and make the setting. So
Yep.
I think that's the thing that's maybe not been communicated that well.
Yes, absolutely. Like I said, it's at all airlines. It's an IRS change. So obviously it's going to impact all pilots that are over 50. And so definitely a timely
Yeah.
election.
What are the other ones that you have that I think Roth NEC option? What about that one?
Yes. So I think three changes that we saw, and we mentioned one was the over 50 that, and you make over 150,000, then your catch up's going to have to be Roth, 8,000 in 2026. The other one is that you can defer 80% of your income. And then the third one is the Roth NEC. And you have an option, I guess I should say, to make your NEC Roth. And I think the things to consider there is who's it good for, who may not want to do it. And again, this is very personalized and very on your own preference. But I would say to think about it as if, are you doing your employer contribution? Is that Roth already? So if you're doing pre-tax right now and you're not doing Roth there, then, well, you don't want to do Roth NEC most likely, right? Because you would rather go ahead and do your employee contribution Roth for a few reasons. For one, that's the hierarchy of priorities. But then secondly, they're going to withhold taxes when you do Roth employee contribution. Whereas for the NEC, Charlie, as we know, you're going to have to withhold taxes on your own and pay them on your own, which is much more painful and a lot more burdensome in terms of time and saving that in a bank account, and where that means making estimated tax payments or not. But what else would you add to that? I can get into more of who else it would be good for, but
no, that's perfect, because it's one thing when my employer withholds my tax, and I may or may not notice that if it's a couple $100 a paycheck because the pay fluctuates so wildly. But it's a whole different ballgame if you turn on, in some cases, $47,000 of what previously was not taxable that is currently taxable, and there's no withholding. You're gonna have to make estimated tax payments, probably, and that's painful. And if you don't, you're going to get shellacked come tax time with a $15,000 tax bill. So think about that one carefully.
Absolutely. And then the other thing I was thinking about our scenario is just, let's say you tell us that, okay, we want the 24,500, my employee contribution. I want that Roth, and I want more Roth after that. But that doesn't mean you have to go straight to the NEC. You could also do the backdoor Roth IRA, which we'll get to later, but that would allow you to get even more Roth monies in there without having to do the NEC.
Yes.
Now, who it may be good for is for someone on disability, or really just in general, if your income is going to be lower for whatever reason in a given year, it could be a good opportunity to, you could fill your 401k bucket up with Roth. And then if you still want more, then you could make that NEC Roth. Now, Charlie, you maybe you could walk through the mechanics of that in terms of, I know it's a on or off switch that you can do. And it's not really like, hey, I want to do this percentage of NEC. It's just, if you click on, it's just going to do all of it until you click off. So
that's right.
But,
you'll be doing maybe clicking on and off a lot throughout the year, maybe.
That's right.
To meter that. I don't know. But yeah, I think I love what you said. In fact, this past week, we had a couple of our clients and they've been out on disability. We did the tax, homework, if you will, the due diligence. And they decided after that discussion to go, hey, I'm gonna do, first of all, 80% of my pay to my 401k, because it's sick time now or vacation. I want to make 80% of that go to my 401k. And I want my NEC to be Roth, and I want all of my 401k to be Roth, because their income is just significantly lower. So they're happy, again, they're situation dependent. They're happy to prepay that tax at lower tax rates. So.
Yeah, and I've seen that as well. And I guess the other situation I've seen is, if I know we say if you're on disability, it may be good, but if a pilot is going to come back mid-year and fly for the rest of the year, then you got to think the IRS looks at your income for one year as a whole, not just that first half of the year. So you wouldn't want to get, your income go way up and then get surprised at the end of the year that you're in a higher tax bracket than what you may have thought. So you could always wait. You could wait a little longer. It's not something that has to be done right now, I guess. Right,
That's a
Charlie?
great, yeah, you nailed it, Nolan. That's great. Something to watch out for. And it just takes some thoughtful planning but it's a great opportunity. We've got some really smart O's that understand it after talking, and they know the value of getting that money into Roth. And so, good on them. They're doing it, and they've recognized that it's worth it to them.
Right.
So that's
Absolutely.
great. I love it. All right, awesome. Well, Nolan, that is just a review of last podcast. We just want to kind of repeat that until we reach as many people as we can.
Right.
So get in there and make that change. If you're 50 or over, you've got to make a change, and you've got to make sure to get that Roth catch-up contribution in there if you want to. All right. So Nolan, moving on a little bit more. Last week, or last podcast, we talked about, are you headed for a tax bomb? Are you deferring too much? Sometimes the tax becomes so painful as an airline pilot, as a professional pilot, fractional pilot, whatever, the tax just gets painful. And so this inclination is, okay, I want to defer, reduce my income as much as possible, as many deductions as possible, market-based cash balance plan, pre-tax 401k, on and on. But then we've seen people, Nolan, get into retirement, and now they have zero options. And so we'd love to avoid that. Now, if you're 64, we're going to have some other suggestions, but it might be a little late, quite frankly, until you retire and maybe your income's lower, then you can do some conversions. But we don't want people to wait till 64. Hopefully they get there and they've got some options anyway. So that's what we're hoping for.
Absolutely.
All right. So, well, let's jump in. I think Kitsis, where's his quote? He says, the fundamental point, Michael Kitsis, by the way, is a super nerd that we follow, read, on and on and on, just one of the smartest guys in our business, he and his team. But he says the fundamental point, though, is simply to understand that the best way to plan around taxes in retirement is not to defer too much income or too little, but to seek out and find the equilibrium rate that balances them out. All right. Easier said than done, Nolan. So it's just a constant analysis, right? To try to figure out that balance.
And sometimes it can, maybe a little, I wonder how much, fear of missing out, maybe, when I think Roth is really, people hear about Roth so much now, right? And if you're just looking online or listening to videos, you're going to see a lot of different opinions on it. And, I think that quote to me just says that it doesn't have to be all or nothing, right?
Yeah.
Like, you want a good balance, because if you're in the 32% tax bracket and, you're putting all your money in Roth, that's not bad if that's what you want, but it could, you're going to be paying a lot of tax right now. And I think it just requires a lot of careful planning. And at the end of the day, no one knows, right? Because it's all a bet on future tax rates. But Charlie, like you always say, even if we get there and maybe tax rates are the same, or a little higher, the flexibility that money can provide you in retirement is really, really huge. And that's kind of a bonus in and of itself.
Yeah, it's that peace of mind component. Nobody gets to 65 or beyond and says, daggone, I got too much Roth. I wish I didn't have this much Roth. Nobody says that because it's tax free. And so just imagine yourself in retirement. Congress, the politicians are doing what they do, talking about raising taxes and the debt and deficit, all these things that lead to higher taxes. And you're just sitting there fat, dumb, and happy, for lack of a better phrase, because you got tax-free money. I mean, that's a pretty nice luxury, and it eliminates uncertainty. So those are some things that don't show up in the math, like you kind of were alluding to. But well, let's jump in and talk about some of these strategies. And Nolan, you said, hey, let's go back to the basics. So let's lay that foundation before we start to get into something kind of complicated, because there's some misunderstandings out there.
Yeah, absolutely. I mean, like I mentioned we got backdoor Roth IRA, you got Roth IRA, you got Roth 401k, you got Mega. I think it can get confusing, and we deal with this stuff a lot, And so I think a common question we get is, okay, I contributed to the Roth 401k and I've met the limits, so I can't do the Roth IRA. And so I think the first important distinction to know is that the IRA, whether that be a traditional IRA, Roth IRA, or backdoor Roth IRA, that's its own limits. So that's just think of that as its own separate thing. And then the 401k Roth, that's also its own limits. So even if you max out your Roth 401k, that doesn't impact how much you can do in your IRA. You can still maximize both. So I think that's a first kind of a starting point of an important distinction. Troy, I don't know if you'd add anything to that or not.
Yeah. I don't know if I'm stealing your thunder, but there's two things that we also see that we get surprised at sometimes, just misunderstandings. And for example, let's say you have a non-working spouse, no income.
Yes.
It doesn't matter. They can contribute. It's a spousal IRA. So it does, again, both spouses can contribute. This year. 2026 limits are 8,600. So even if your husband or wife doesn't work, 17,200 for both of you, as long as one person has the income.
Yes. And if you're over 50, right? So 8,600.
Yes, that's right.
If you're over 50.
Since I'm over 50, Nolan, that's all I think about.
That's right. And I'm on the, yep. So I'm stuck in that 7,500 for 2026. But
right.
But yeah, so those are the limits. They change every year, kind of like the 401k limits. But that's a really good point, Charlie, and definitely a common misconception. So how about the backdoor Roth IRA? That's something that we get a lot of questions about. And so I wanted to share this graphic here. That's kind of how I learn best. But Charlie, what would you say when we get asked the most when it comes to the backdoor Roth IRA?
Is it illegal?
Yes, that's a good point. I was going to mention the backdoor Roth, mega. Sketchy. These all sound kind of a little sketchy. That's a good starting place. So yeah, it's not. That's a good thing to know is that this is perfectly legal. Of course, that it's IRS approved, and so the reason it's even a thing is because there's income limits, and our listeners have probably experienced this, that if you make over a certain amount, and it changes every year, then the IRS says, hey, you cannot contribute directly to a Roth IRA anymore. Yeah. And so that is where this backdoor Roth comes into play. And I think the name makes it seem a little more complicated than what the end goal really is. But really, at the end of the day, with the backdoor Roth, you are still getting the same amount of money into a Roth IRA at the end of the day. It's just how it gets there is what's a little different. And so I know a lot of our pilots have said, yeah, I hear that a lot, but I don't really know what the mechanics of it are. And so that's what this picture is showing, is that this dollar right here, this is going to be the dollar that you earn from your airline or from your company. So it's already been taxed. And so that's a key part of this. So it's already been taxed. You put it into a traditional IRA. And right here, it says you're not going to take a tax deduction on the money you put into a traditional IRA. Now, sometimes you do. If you're just like you do pre-tax 401k, you would get a deduction for that. But since this money is for Roth, you're not going to take the tax deduction, and you're going to do a form 8606. Now, that's a little in the weeds, but that is important when you file your taxes if you're doing the backdoor Roth on your own. So the money will go into the traditional IRA, and then from there converts into the Roth, and everything after that is the same, grows tax free. But Charlie, what did I miss? What would you add to the backdoor Roth?
I would add another often misunderstood rule is that anyone, regardless of income, can contribute to an IRA. They just cannot deduct it from their taxes. And I would say, Nolan, the vast majority of our clients cannot, and our audience cannot deduct a contribution to an IRA. And even if they could, Nolan, we might go, well, let's forego the deduction and do the directly to the Roth. You know what I mean? So that's the key, is that the people we're talking to, the people we're working with, our audience, they cannot deduct an IRA contribution. They make too much money, but they still can put it in there. It's already been taxed. And like you just were drawing out there for our YouTube folks, the conversion, the law says, the IRS regulation says you can convert it. Anyone can convert it. Doesn't matter. There's no income, but you're going to pay taxes on anything that has not already been taxed on yet. That means, is there any growth? Then yeah, you'd pay income tax on that, but there doesn't have to be. And so now, like you said, you've got it into the Roth. And by the way, the politicians love this because a lot of people do it and they will pay some taxes under certain circumstances. So Congress loves it because they get immediate revenue from Roth conversions. Yeah.
So just to clarify, you're saying be very careful if you have other IRAs with monies in them, because they call it the pro-rata rule, and it's going to be, you're going to get a tax bill that you may not expect if you convert that money. So essentially, if you have a lot of money in IRAs, or even a little bit, they're going to do a formula and you're going to get taxed on that conversion. Yes. Where if you have no other IRAs, you're good.
Exactly right. That is a perfect point. No, I'm glad you brought it up because we can't stress that enough. The example we just gave is assuming no other IRAs, pretty much. It includes SEP IRAs, especially if they were pre-tax. So there's got to be some math done there. Otherwise, there could be tax complications.
Yeah. One question we get is, okay, well, I have this big IRA. Maybe it's a rollover IRA. You had an old 401k. It's in an IRA now, pre-tax. People will say, I can't do the backdoor Roth. I would like to. I have this big IRA balance. Well, if it's pre-tax, then you could roll that into your 401k, your current 401k with your employer. And that clears the way where there's no more balance in that. You're good with the IRS, and then you can convert and it won't be taxable. Yeah. Whereas if you don't do that, then it will be taxable and it's not as advantageous. So that's why you could consider rolling that over. But anything to add to that process, Charlie?
No, I think that's one that people don't know they can do very often is if you have, like you said, pre-tax IRA, stuff it in your 401k. Maybe some people call it reverse rollover or whatever. Right. No, and I want to give just a quick example to illustrate because what we're saying here is complex, a lot of moving parts. But I'm going to pretend that somebody has a $500,000 pre-tax IRA they just rolled over. It's in an IRA. And then they contribute $8,000 or $7,500 to the after-tax. If they convert that after-tax to Roth, like you said, that's going to be a taxable transaction because there's another $500,000 pre-tax IRA that they have to add those two together, and you come up with the ratio. So just wanted to clarify that and give us a real quick example to illustrate that.
Absolutely.
So hopefully that helps. Okay. So Nolan, that's backdoor Roth. That's who can contribute to IRAs. We covered a lot of ground there. And there's still more avenues to get Roth money. And for you and I, that is our goal is, let's start as early as we can and let's start building this infrastructure of some Roth money. Everybody's going to have some pre-tax money probably. And then maybe even some taxable brokerage money. That's another podcast. But somebody asked one time, what's the ratio of Roth to pre-tax we should have? And I was like, how about 100% Roth? Of course, I'm being a little facetious because that's dependent. You don't want to pay too much tax to make that happen. But I don't know the answer to that, Nolan. I don't know there is an answer. And as much Roth as you can get feasibly, remember back to that equilibrium that we started the show with was, that Roth equilibrium is going to be different for everyone. If you're starting at 20, well, then there's a really good chance you're going to have a lot of Roth. If you're starting at 60, that may not happen for you. So those are some circumstances there.
It almost reminds me of when, people ask us, what's the market going to do, right? You would have to know the future to know that. And that's kind of how I feel about what's this perfect percentage between pre-tax and Roth, because at the end of the day, none of us have the crystal ball, right? And we don't know the future. And so we're kind of, I know you say it's overused risk mitigation, right? Like we're trying to mitigate that tax risk in retirement, that tax bomb that you mentioned, but it kind of reminds me of just savings in general, right? I mean, you have to live today, but you also have to plan for the future. And to me, that's kind of what you're doing with Roth is that you're planning for the future. And so you don't want it to be so painful, when you're in the 32%, 37% tax bracket, right? But if you can feasibly do it, like you mentioned, then it's probably worth it.
No, and I'm going to talk to the market-based cash balance plan just for a second.
Yeah.
And then you can talk to us about the mega backdoor Roth mechanics of that or the pros, cons, et cetera. But, a lot of the airlines now, I think Delta, definitely, American is just now turning theirs on. Southwest does not have the spill cash function yet on or approved by the IRS. United's getting ready to get theirs approved probably the next year or two. So I would anticipate in the very near future that all four airlines, those four I just mentioned, are going to have up and running market-based cash balance plans that allow spill cash. So I think that's a great opportunity because you're going to get more money deferred that was previously taxed. If it were me, I would take advantage of that newly found tax deduction, if you will. Again, when spill cash that would have come to you and been taxed, Nolan, instead goes to the market-based cash balance plan, consider then going, oh, well, let me offset that maybe with some Roth contributions. That's just an idea. Again, very based on circumstances. They're not advice because it's just so nuanced, everybody's situation. But just keep in mind, as these market-based cash balance plans come online, that is an opportunity, I think, that people should consider. So Nolan, the market-based cash balance plan can be beneficial for that. But there's another one that a lot of airlines have the availability to do. I think all of them, quite frankly, except Southwest. And this is FedEx, UPS, United, Delta, American. I think all of them do it. But it's the after-tax contributions, AKA your favorite mega backdoor Roth. I think that's what we call it. But what about that?
Yeah.
How do we take advantage, and should we, you think?
Yeah, you gotta love those names, the backdoor, the mega. But yeah, you ask a good question. Should we take advantage of these? That's what we're going to go through is who is this good for? But first thing, it's important to know what is the mega Roth. And kind of by the name, it's just, as you mentioned, it's really just another way to get more Roth once you've already been doing all these other things, right? So if you're contributing to your Roth 401k and you're maxing that out, and you still want more Roth, then this is a way to do that. So again, just a way for high earners to get more Roth in the 401k. And how it's possible is that the pre-tax option and the Roth option, the IRS limit of 24,500 applies, right? That's if you're below 50. If you're over 50, it'll be 32,500. But that's usually the most that you can defer as an employee into the 401k. Now, this third option, as you mentioned, that most other airlines offer except Southwest, you'll notice a third option on your options will say pre-tax, Roth, after-tax. The after-tax is what allows you to go above and beyond those limits of the 24,500 or 32,500. And so the after-tax bucket, it's exactly what it sounds like. You've already paid tax on that money. And you may say, well, that sounds a lot like Roth. Well, the difference is that the basis of the after-tax money that's already been taxed, that is tax-free, and that's Roth. But the above and beyond that, if that money grows, you're going to pay tax on that money. So that's an important distinction.
Yeah. So Nolan, I mean, it's amazing. And I think you're getting into, this is technical, so it's hard to follow, and I'll try to recap a little bit, but clearly there's a priority here of savings. Maybe if I can cleanly do the backdoor Roth, maybe that's the first easiest thing to do. But if you've done that and you're like, hey, I could do more Roth, and this may be someone that has multiple income streams, married couple or whatever, because you've got to really put a bunch of money in the 401k for this to happen. So you nailed it earlier. You normally get 24,500. If you also put in an additional 5, 10, 15%. So for example, let's just say 72,000, which is the limit. You put in 24.5. That means the airline puts in 47.5, and 72,000. That's the max. That's hit. If you, Nolan, put in instead of 24.5, if you put in another 15 grand, then that's just 15,000 less that your airline can do because you squeeze them out. But you got to do it really fast early in the year because these airlines are putting in 18% for the pilots.
Right. No, that's
like a little race. It's like a race to 72. In fact, Kevin, Kevin Gormley, the professor who's on here sometimes, just did a video, The Race to 72. The idea is that you get all that money in there as fast as you can. The company, the airline, instead of 47.5, they put in less because you squeeze them out because of that $72,000 limit. And then that money, that spill cash, still comes to you either in the market-based cash balance plan or spill cash to your paycheck. But like you said, you can then instantaneously or tell Fidelity or Schwab, whoever, to convert that money to Roth. And so it's pretty phenomenal.
Yeah, and that's probably an important detail, right? Because as I mentioned, if it's after tax, the growth will get taxed. So ideally, you would want to get that converted as soon as possible. Yes. So you pay little to no tax, and there's no room for growth before it's converted. And as you mentioned, now there's a lot of features where usually it can be done automatically. It would depend on the plan, but
No, and I'll throw one more thing in there just to hopefully add some color to this. And that is just like the backdoor Roth. I mean, there's no again, if there's no other pre-tax IRAs anywhere, that conversion may not trigger any taxes. Let's say it doesn't in that scenario. So great, it doesn't cost me any more taxes, but I still have to save more. So that's the challenge of it. That's exactly like the mega backdoor Roth or the after tax in the 401k. It doesn't, I'm not going to pay more taxes by doing that, but I do have to save a lot more. So that's not easy either, right? So that 24,500, if I turn that to Roth, well, I'm going to pay more taxes. So it's either like you choose to pay more taxes by doing Roth 401k, or you choose to save more and then convert to Roth. So hopefully that helps a little bit.
Yeah. I mean, I think for me, it's like this is a lot of money we're talking about, right? I mean, not a ton of people are probably able to do this, and that you may be eligible, but there's also life too, right? So Charlie, let's bring this to life a little bit with an example. Like you said, this can get really complex really fast. So let's just say a pilot, you're flying 80 hours a month, pay rate about $250. So your annual earnings will be $240,000. And for this example, the pilot's over 50. So you're going to be able to put maximum 32,500 into your 401k. So I'm going to do a deferral of 14% for the pilot. And then you'll have the 8,000 catch up like we already talked about. And then we're going to do 5% after tax. And so as I mentioned, most of the time, if you're not doing the mega Roth, 32,500 is the most you're going to be able to get into your 401k for this pilot. But in this example, the pilot would actually get 42,500 into the 401k from their deferral. So that's the 14% that they're deferring of 240,000, and then the 5% after tax. And with the catch up for over 50, they're going to be able to get 42,500. So you can see how that's more Roth than they, of course, would have gotten before. And as you mentioned, Charlie, since their contribution, what they're putting in is going up, it's squeezing the company non-elective contribution out. And so instead of 47,500, for example, in this case, it would be 37,500 because the employee put 10,000 more than what the standard IRS limit is. But the important distinction is that either way you slice it, even if you do mega Roth, 80,000 is the maximum that pilot's going to be able to put in the 401k. I think that's the upshot too, is that you're not going to be able to go over that amount. So maybe you can simplify what I just said for our pilot audience.
I think that's helpful to go through that example. And as you can see in this example, the pilot got $10,000 more of their own contributions into their 401k than they otherwise would have. It's $10,000 of after-tax contributions. And then Fidelity is a Delta example here. So Fidelity would convert that automatically to Roth. That's 10,000 more of Roth you just got. And Delta only put in 37.5 instead of 47.5, but they're going to put that money in the market-based cash balance plan anyway. So there's some things to think about there as far as how much is going to the market-based cash balance plan. But nonetheless, I think that example illustrates the benefit there of helping to get more Roth if you're in a position you can save that. That's a lot of savings, like you said, Nolan.
Absolutely, yeah. And so maybe to recap, it's just because someone's able to do the mega Roth doesn't mean that it's the right thing for you to do.
Feel free to give us a call or email. We can go through that simulation with somebody's circumstances if they want to. But Nolan, I think those are the things we wanted to hit on today. I mean, it gets pretty nitty gritty. Hopefully people hung with us because when one retires, there's still more opportunities. Usually when someone retires, they're in a lower tax bracket, depending on their spending, and they might consider converting to Roth after retirement until they start withdrawing Social Security or RM. And so that's a well-known strategy as well. But it just depends on how much you're spending. Clearly, if you're spending a lot one year and you're in the 32% tax bracket, maybe that doesn't make sense to convert that year. But we're always looking for that opportunity to do that, just depending on someone's circumstances.
Absolutely. Love it.
All right. Very cool. Well, Nolan, any parting shots, anything you're thinking about? Did you get frozen in Owensboro, Kentucky up there?
It's 40 degrees today. The ice or the snow ice is finally starting to melt. We had about eight inches here, been stuck inside. So yes, I am glad, but I think that's a good call. I think it's a good ending point. There's a lot to digest today for sure. The Roth.
It is a lot. Yeah. Thanks for going through that with us, Nolan. And again, we appreciate all of our pilot audience out there. Please share the podcast, or at least share the idea that if you're 50 and over, you better get in that 401k and make the change, because you could miss out on getting that in there, possibly depending on what airline you're at. The rules are a little bit different each airline. So let us know if we can help. Share the podcast. Please rate it and review. That helps us to reach more people. And we're always open to ideas. Shoot us a message, email, YouTube. We're on YouTube as well, so you can comment there and we'll respond. All right. Thanks, Nolan. Thanks for hanging with us today. We'll see you next time.
Thank you.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.